Mutual fund is a pooled investment vehicle that pools money from many different investors for a specific purpose. And let's use, for example, Fidelity as an example. Fidelity has a mutual fund called the Magellan Fund. And Magellan Fund was run by this person by the name of Peter Lynch for many years, from 1977 to 1990. Peter Lynch ran this fund. So Magellan would collect funds from investors and it would invest it into this Magellan Fund, and Peter Lynch and his team would decide how those funds would be invested. And their goal was to do capital appreciation. So they had a very broad range of what things they could buy. They could buy US small companies, they could buy international stocks, they could buy US large companies. They essentially bought companies that they thought that they're going to do well. Now, a mutual fund could also be an index fund. If a mutual fund is an index fund, there's no manager involved. The mutual fund essentially buys the assets of that particular index, and I'll continue to use the S&P 500. So Fidelity also has an S&P 500 fund, and in that fund, there's no fund manager, there are no investment decisions. The money that's pooled to invest in that Fidelity S&P 500 fund are essentially invested entirely in S&P 500 and then mimics the returns of the S&P 500.